and welcome to the Diamond Hill podcast. I'm Lara Hoffmans, head of marketing, and I'll be your host for today. Today, we're diving into fixed income markets, how they've performed so far in 2025, what's been driving the volatility, and what investors should be focused on as we head into the back half of the year. Before we get started, just a few quick reminders. At the bottom of your screen, you should see a few icons. One of those is the Q&A button. You can submit a question at any time. We'll address those either throughout as topics come up or at the very end. We will also post a replay of this event on our website in the coming days. So if you cannot stay on for the duration, which we expect to be about 30 minutes or so, or if you'd like to pass along the replay to a colleague, you'll be able to do so once it's posted on our website. And then one final reminder, the event is being recorded and all opinions expressed are those of the speakers as of today, July 17, 2025. And those views are subject to change without notice. With that, let's get started. It's been a dramatic first 6 months, to say the least, marked by geopolitical flare-ups, shifting Fed expectations, and a wave of fiscal headlines that have tested even the most seasoned investors. To help us make sense of it all, I'm joined by Douglas Gimple, our Senior Portfolio Specialist for Fixed Income here at Diamond Hill. Doug's got his finger on the pulse of the bond market and will help us unpack not only what just happened, but where we might be headed next. Doug, welcome back. Always great to have you.
Thanks, Laura. I'm very glad to be here.
Great. So to start off, to get us started, how would you characterize the fixed income market's performance through the first half of 2025?
Well, I think the best way to describe it would be a bit of a roller coaster ride. The strong performance that the fixed income markets experienced in 2024 carried into the early months of this year before the entire market's focus shifted to the tariff announcement on April 2nd. So consider the first few months of the year as the ride up, the initial big hill of the roller coaster with riders anticipating the fun dips and twists ahead. But little did we know that we were riding the kind of monstrously intense coaster that my daughter would love and never get me on, instead of a more timid ride like, say, Goofy's Barnstormer. The tariff announcement jolted the global financial markets and created volatility not seen since the days of the global financial crisis or the early days of COVID. Now, if you had gone on vacation on the first day of April and came back on the final day of the quarter, you could look at the performance of the financial markets and think, not a bad quarter at all. But it's all about the journey and what a journey it was during the second quarter. Those 3 months kind of felt like 3 years, with the S&P 500 posting its fifth largest two-day decline since the Second World War, oil prices jarred by the short-lived Israel-Iran conflict, and ongoing U.S. fiscal concerns. In the fixed income markets, which we'll discuss in a bit more detail later on, Treasury yields reacted substantially to every piece of economic news, as well as revisions to tariffs. And while spreads across risk assets pushed higher before settling back down at the end of the quarter, near, and in some cases, tighter than they started the quarter. Despite all these gyrations, uncertainty, and volatility, the fixed income markets, as measured by the Bloomberg U.S. Aggregate Bond Index, delivered the best 6 month start to a calendar year since 2020.
So I do believe that this marks our first ever Goofy Barnstormer analogy to credit markets. So let's just all mark that down on our calendars. So the quote unquote Liberation Day and the associated tariff announcements at just after the start of Q2 shook markets. Again, that's a bit of an understatement. How did this event specifically affect the fixed income space?
So let's keep the roller coaster analogy, but this time let's apply it to volatility measures, spreads, and interest rates. The MOVE index, which measures U.S. bond market volatility by tracking a basket of over-the-counter options on U.S. interest rate swaps, rocketed to nearly 140 on April 8th. By way of comparison, the historic average from the turn of the century to now is 89.6, and specifically during periods of stress, the index reached 264 during the financial crisis, 163 in the early days of COVID, and nearly 200 during the regional banking crisis of 2023. But much like every other part of the market, the MOVE index retreated to end the quarter at 90.3. Spreads in risk assets, essentially what a bond investor receives in additional yield over comparable duration treasuries, pushed wider throughout the month of April before pulling back close to their original starting levels by the end of the quarter. Specific to the treasury market, the curve experienced a bit of a twist, with the shorter end decreasing and the longer end pushing higher on concerns about the fiscal situation in the United States, which I know we're going to talk about in a little bit. The volatility that hit the overall financial markets didn't spare the treasury market. Consider that the 2-year treasury yield dropped from 3.89% to 3.72%, which is a move of 17 basis points. But it traded in a range as high as 4.05 and as low as 3.6 during the quarter, which is a range of 45 basis points. Quarter over quarter, the 10-year treasury barely moved, but covered a range of roughly 61 basis points, ending the quarter 1 basis point higher at 4.24%. And the 30-year treasury yield increased 19 basis points from April to June, but yielded as high as 5.09% and as low as 4.41% before settling at 4.78% at quarter end. Returns were skewed along the curve, with the shorter end generating positive return and the longer end negative.
So let's go ahead and address that fiscal situation. What was the significance of Moody's downgrade of U.S. debt, and how did the market react? And did it matter as much as headlines might have suggested?
To be honest with you, Laura, it kind of felt like a non-event, as Moody's, in my opinion, was pretty late to the party. I mean, you have to recall that S&P delivered the initial downgrade of U.S. debt from AAA to AA+ back in August of 2011. And Fitch followed that up 12 years later with the same move in 2023. Frankly, my first reaction was, what took so long for you to catch up with the other rating agencies in the rest of the world? The current fiscal situation isn't attributable to one specific administration, but it's the result of years of massive spending. The last time the US federal budget was balanced was fiscal year 2001 under then President Bill Clinton. We've been kicking the can down the road for close to 25 years with debt ceiling extensions, government shutdowns, and political wrangling. And the only thing that's really changed is the exponential growth of the deficit. The passage of the recent bill will only compound the issue, as a Congressional Budget Office and several independent think tanks estimate that the bill would increase the deficit by anywhere from 3 to 5 trillion over the next 10 years. Now, in all fairness, this estimate from the CBO does not account for any kind of economic impact that's derived from the passage of the bill, so it may not be as severe. From an investor standpoint, the downgrade announcement felt like a non-event. Most institutional investors had already adjusted guidelines to account for the initial downgrade of the US debt back in 2011. Longer end bond yields ticked higher in the following days, but it felt like it was fueled more by ongoing fiscal deficit concerns and a weak 20-year treasury auction than Moody's actions. To put the downgrade into perspective, there are only 2 companies that hold AAA ratings from S&P, Johnson & Johnson and Microsoft. And are you going to place them above the US government when it comes to the risk of repayment?
Well, that is a very good point. So let's shift now from a fiscal lens to a monetary one and the Fed, which stayed on the sidelines throughout Q2. What do you think kept them there, and do you expect that patience to continue?
The Fed continues to take this wait-and-see approach, despite ongoing jabs and threats from the administration to lower rates. Raphael Bostic, who's the president and CEO of the Federal Reserve Bank of Atlanta, provided an insightful analogy that does not include Goofy's Barnstormer, as to how various members of the FOMC are reacting in the current environment. He said that it felt as if the FOMC was driving along and suddenly ran into a very thick patch of fog. Some members pulled off to the side of the road, while others slowed down substantially, not knowing what might be around the corner. This fog of uncertainty around factors like tariffs and other policy decisions that impact the overall economy is making it difficult to see the future, emphasizing the need for caution and patience. The market's been waiting to see how tariffs may impact inflation, and frankly, we're still waiting. The ever-shifting nature of tariffs doesn't help. It just delays the eventual impact, if any, that they will have on pricing. So the Fed will wait until the fog thins out before making any moves. We've talked about this before, but it's important to reiterate that the Fed's in a tough spot. If inflation increases, the textbook move is to raise rates to slow inflation. But if the labor market weakens, the Fed should be lowering rates to help revitalize the economy. But what happens if both occur at the same time?
Well, I hope we don't find out. But there has been chatter about a shadow Fed chair scenario. How real is that risk to market stability?
A very timely question. As we just talked about, the Fed's remained on the sidelines. But they've not stayed out of the administration's crosshairs. Continued calls from President Trump for the resignation of Jerome Powell have fueled financial news networks, but they don't really seem to have gotten to Powell. But just yesterday, reports began to surface that Trump had met with Republicans and had openly discussed terminating Powell. These reports it was almost funny how quickly they were disputed by Trump himself during a press conference later in the day at the White House. The prospect of a shadow Fed chair is something new, and it refers to the nomination or designation of Powell's successor before his term expires in May 2026. The announcement of the next Fed chair prior to the current Fed chair's term ending has never happened before and could bring instability to the financial markets, as the appointed person could undermine Powell's authority in the final months of his term. So Laura, imagine a press conference from the anointed chair wherein he or she is speaking of lowering rates aggressively, yet they have no power or influence until May of next year. Those comments could be in direct conflict with the Federal Reserve's various members' current stance and overall message, creating significant uncertainty in the market. And we all know the market hates uncertainty. The threat of a shadow Fed chair does not seem sufficient to derail the FOMC's current approach of patience and data dependency. And it's important to remember that monetary policy is determined by the FOMC, not the Fed chair. Powell is one of 12 voting members of the FOMC, and possible replacements would most likely fight to maintain the autonomy of the institution.
So let's now pivot to go a layer deeper here and talk about sectors. Corporate credit held up well despite volatility. What drove spreads tighter by June 30th?
In the investment-grade corporate space, spreads pushed wider throughout April, with the Bloomberg U.S. Corporate Index Option-Adjusted Spread, or OAS, climbing from 93 at the end of March to a peak of 118 by April 8th. That peak in spreads exceeds levels reached during the yen carry trade unwind that the markets navigated in August of last year. But by the end of the quarter, spread levels had tightened to a level below where they began the quarter and below the historic average since the turn of the century, which is roughly 147 basis points. The spread tightening occurred throughout the latter part of the quarter as the markets adjusted to the prospect of tariff uncertainty and the financial markets stabilized. But even with all the noise during the quarter, the corporate index delivered nearly 2% in returns, building on the 2.31% return from the first quarter and generating the best 6-month start to a calendar year since 2020. High yield followed the same trajectory as investment-grade corporate debt, but with even more volatility. The Bloomberg U.S. High Yield Index was down as much as 2.76% from March 31st through April 8th, before generating a return of 6.46% from April 8th through the end of the quarter, finishing the second quarter with a return of 3.53%. High yield spread levels jumped roughly 116 basis points higher between April 3rd and April 7th, while the yield to worst climbed to 8.67%, its highest level since 2023, before rallying through the end of the quarter to finish at 7.06%. As with the investment-grade corporate market, acceptance of the tariff-inspired volatility and the new environment ground spreads tighter.
So within securitized products specifically, which segments stood out this year and why would that be?
The securitized market was really no different than other risk sectors, with spreads widening on the heels of the tariff announcement before spending the remainder of the quarter moving tighter, closing within shouting distance of pre-Liberation Day levels. Laura, as you and our listeners know, we tend to favor the securitized markets over other areas of the fixed income universe, and this remained the case through the volatility of the second quarter. Even as spreads widened across the spectrum of fixed income investments, we believe that the segments within the securitized markets continue to offer attractive relative value. The rate volatility during the quarter hit pass-through mortgages a bit harder than other areas of the mortgage market, such as collateralized mortgage obligations. But overall, the securitized market held up pretty well. Through the halfway point of the year, residential mortgage-backed securities have been the strongest performer in the securitized market. CMOs, as I mentioned earlier, offer unique cash flow structures relative to plain vanilla pass-through mortgages, and they're also backed by agency mortgages, and they've held up very well during the rate turbulence of the past 6 months. Listeners should note that the Bloomberg U.S. Aggregate Bond Index does not include CMOs in its mortgage allocation, only pass-through mortgages, and this provides investors an opportunity to differentiate from the benchmark. Non-agency commercial and residential mortgage-backed securities carried over the strong performance from 2024 into the early months of 2025 before pulling back slightly during April, but finishing the quarter strong.
So, Doug, I know your team keeps an eye on what's going on in the consumer space as it relates to securitized. So what role have consumer credit indicators, such as delinquencies, played in your evaluation of securitized risk and opportunities this quarter?
Consumer-related securities such as credit cards, auto deals, consumer unsecured ABS provide valuable insight on a monthly basis through remittance reporting, essentially a financial statement of the underlying loans within a security. These reports provide key insight as to how the consumer is handling their debt load. From what we've seen recently, it would appear that the consumer is stabilizing, with delinquencies on subprime and prime auto increasing by 0.1% over the past quarter, and credit card delinquencies decreasing by 0.2%. In consumer loans, traditional loans acquired and serviced via physical branches have seen delinquencies decrease by 0.4%, and marketplace lending, which are online loans, have remained flat over the past quarter. It's important to note that every deal is different and is built with credit enhancements that are in place to help mitigate some of the impact from delinquencies that come with underwriting consumer debt. When these deals are underwritten, whether auto, consumer unsecured, or credit card, they're done so with an estimated level of loss. As we all know, no firm is perfect in underwriting, and consumers can face many different challenges that impact their financial situation. The remittance reports provide investors with the transparency needed to determine the underlying value of the loans as time goes by. For instance, loosening underwriting standards in 2021 and 2022 resulted in deals that performed much worse than expected, which became apparent through these remittance reports. Underwriters reversed course and strengthened standards, increasing the overall credit quality of newly issued deals, and we've seen much better performance in recent vintages. When we are assessing the risk of a consumer-related security, we run that security through a variety of stress tests, essentially trying our best to, quote, break the bond. In other words, how bad do things have to get before a particular bond we are evaluating experiences a loss? Along with strengthened underwriting standards, issuers that structure these deals can adjust credit enhancements to entice investors to invest in these deals.
So let's turn now to the core bond and short duration securitized bond portfolios. Starting with core bond, could you provide for us a brief review of what factors helped and what hindered performance year to date?
So from a sector standpoint, the core bond corporate allocation outpaced the benchmark allocation over the first 6 months of the year, thanks to strong security selection within the sector. However, the relative underweight posture meant the overall impact was a slight detractor from performance. The securitized sector was the best performing component ahead of the benchmark performance. Specifically within the securitized market, the agency residential mortgage-backed securities allocation contributed positively to relative performance, as a portfolio's allocation to agency CMOs held up better than plain vanilla pass-throughs during the turbulent time in the rates market. Non-agency commercial and residential mortgage-backed securities contributed to performance with both sectors, having benefited from investor appetite for areas of the market that have been beaten down in recent years. The portfolio's treasury allocation, which maintains a longer duration posture relative to the benchmark's allocation, meaning that it's more sensitive to interest rate movements, detracted from performance as the move higher on the longer end of the curve resulted in negative performance for the allocation, while the benchmark's shorter treasury allocation return was positive.
So let's stay with the core bond portfolio for just a bit longer and discuss positioning and any significant changes this year and what might be driving those changes.
Laura, as you and our listeners hopefully know, a key tenet of our investment process is a focus on bottom-up security selection, searching for relative value across various fixed income sectors. What this means is that traditionally, our allocations will not shift dramatically quarter over quarter or even year over year as changes made to the portfolio occur at the margins. If we look at shifts over longer periods of time, you will see gradual changes in allocations that are driven by day-to-day opportunities in the marketplace. An example would be the shift over the past couple of years as the asset-backed securities weighting has declined and non-agency residential mortgage-backed securities has increased. This is not to say we aren't finding value in the ABS market. Laura, I think about the shifts in allocation in terms of incremental dollars coming into the strategy, either through monthly paydowns or new inflows. The distribution of that incremental dollar will change as opportunities change in the marketplace. Specific to shorter duration ABS, sector has been viewed more and more as a safe allocation, driving spreads tighter as investors continue to flock to the sector. Since the beginning of the year, we've seen a slight shift in allocation within the strategy, with an increase in agency residential mortgage-backed securities and non-agency commercial mortgage-backed securities, as these sectors have offered attractive valuations during the market dislocations we've seen so far in 2025. The corporate allocation has reduced slightly as the spread widening in this part of the market occurred over a very short time period and coincided with similar moves in the securitized market, which we believe offer better relative value. The treasury allocation within the benchmark continues to increase, accounting for more than 45% of the Bloomberg US Aggregate Bond Index. And the strategy allocation increased slightly since the beginning of the year, while maintaining that longer relative duration posture that I mentioned earlier to offset some of the impact from being underweight.
So let's turn our attention now to the short duration securitized bond portfolio with two similar questions. Can you provide us an overview of what's helped and hindered performance so far year to date?
Yeah, the portfolio's allocation to both corporate and treasury sectors detracted from relative performance since the beginning of the year, as these sectors could not keep up with returns from the securitized allocation, though both the corporate and treasury allocations delivered positive returns. These allocations are small relative to the securitized sectors, so the impact was limited. Spreads on the shorter end of the corporate curve finished the period at compressed levels, remained tight relative to various segments of the securitized sector. Performance in the securitized allocation was driven by continued strength in the non-agency residential and commercial mortgage-backed security sectors, both of which continue to benefit from investors' search for yield in markets that, as we discussed previously, continue to recover from prior year's challenges. Within non-agency CMBS, areas such as single asset, single borrower securities and commercial real estate collateralized loan obligations led the way, while the ABS allocation was fueled by strong performance in the equipment and unsecured consumer allocations. With interest rates fluctuating this year, well-structured CMOs held up well, but did not keep up with the stronger areas of the securitized market.
So let's turn again to positioning. Can you share if there have been any significant changes this year? And again, what's behind those changes?
Well, first, I would just reiterate what we talked about just a bit ago when we were discussing the core bond strategy. Our allocations will not shift dramatically quarter over quarter, as changes made to the portfolio are usually at the margins. Unlike the core strategy, the short duration securitized strategy must maintain a minimum allocation of 80% to the securitized market. As of the end of the second quarter, the strategy holds roughly 86% in securitized sectors, above the minimum required level and near the peak of historic allocations. This is a direct result of the relative value that we're finding in the securitized market compared to investment grade corporate bonds and treasuries. Since the beginning of the year, the allocation to ABS has decreased, mainly due to my earlier comment regarding the market's push into high quality ABS, which has resulted in tighter spreads in the sector. Using the incremental dollar analogy from before, we're still investing in the ABS market, but we've been shifting a bit more into both non-agency commercial and non-agency residential mortgages since the beginning of the year, as these areas of the market continue to offer attractive relative value. Within the ABS allocation, the strategy focuses on subprime areas of the market where there's hard collateral, like autos, and in near prime and prime in areas such as credit card and consumer unsecured.
So we have arrived at the Q&A portion of our programming, and I will kick us off with this forward-looking one. Doug, as we look toward the back half of 2025, what are the most important themes or risks you think fixed income investors should be cognizant of and watching closely?
Where to start? First and foremost is the uncertainty around tariffs, their implementation, and the overall impact on the economy. As we've learned over the last quarter, things can change very quickly with tariffs, from when they're announced to when and if they are implemented, as well as delays in the overall process. Any potential inflationary impacts that could come from tariff implementation should start to be realized in the coming months, which could impact any potential actions from the Fed, which leads to the second major concern: how will the Fed react to incoming data, as well as the continued harassment from the current administration? As we discussed earlier, the potential for a shadow Fed chair announcement in the coming months could create substantial uncertainty in the financial markets with potential conflicting messages. And we also have to consider what's happened in the last couple of days with Trump saying he's going to fire Powell, then backing off and saying he's not going to fire Powell, and then the investigation, you could call it, into the renovations at the Fed's headquarters and what issues that could create. So there's still a lot of moving pieces regarding the Fed. Lastly, I think additional insight into the path of the economy will be key. That ranges from continued data on the labor market to the trajectory of inflation to any kind of geopolitical disruption, whether it be the potential for a flare-up in the Middle East or an escalation or truce in the Ukraine-Russia conflict. As we discussed, spread levels for risk assets have tightened considerably after the upheaval we've experienced in April. So we'll be keeping an eye on the markets for signs of weakness, really ready to exploit any kind of opportunities.
So our next question relates to specific sectors. So which sectors within fixed income do you believe are best positioned for the back half of the year? Corporates, securitized, treasuries?
Our bias has always been to the securitized markets, as we believe the various segments offer significant advantages relative to both corporates and treasuries, whether due to structure or spread levels. There's not one sector that we believe is better positioned than others. And we tend to focus on the specific opportunities rather than state that we broadly like this sector or that sector. It's all about security selection and looking for relative value. Within any sector, there are risks and opportunities. You have to be willing to dig into the weeds to find the best value. And as we talked about earlier, spreads have compressed across the spectrum of fixed income investments, from investment grade corporates to high yield corporates to the various securitized sectors. As it stands currently, we believe that we can find a bit more value in the current spread levels in the securitized market, especially when you're comparing that to investment grade corporate debt.
So that brings us to 30 minutes, which is what we vowed to take from our listeners' time today. So we will wrap up. If you had questions we could not get to, please follow up with your Diamond Hill representative. Doug, thank you for joining us today. Be sure to visit us at diamond-hill.com for our latest insights from Douglas and the rest of the fixed income team and our equity teams. Register to get our insights directly to your inbox and follow us on LinkedIn.